Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short. My name is Alex, and I'm just going to go ahead and review the stock market and futures, some commodities as well. So without any further delay, let's go ahead and review these key markets. Alright, let's go ahead and review the dollar index. Dollar index has a great possibility of breaking down below this level, basically because of permanent open market operations. The Federal Reserve basically goes off and buys a bunch of treasury bonds. That in turn inflates the economy. That in turn puts more money into the economy. And they're basically printing money into the economy. That inflates the economy. That is what makes the dollar index go lower. Now, as you guys have seen from 2003 until now, all you have seen is a downwards trajectory in the dollar. The main reason being is inflation, as you guys can all expect. If you guys have checked the price of a Big Mac from 2000 until 2011, you guys know the steep price rise of how much a Big Mac has costed us as an American civilization. Why? Well, the main reason is because of inflation. You have a ton of money being created out of nowhere, caused by loans. People are getting richer all of a sudden. The rich get richer, poor get poorer. But basically what goes on is that a ton of money is created out of thin air from a ton of loans, a ton of bogus, a ton of stimulus, cheap interest rates from the Fed. All sorts of junk just piles up together, and that creates a ton of excess in dollars. And basically what happens now is that even with the crisis in 2008 and fears that our monetary system would collapse, that in turn would cause massive deflation. We were never able to get back to the levels we saw previously in 2003. So that basically implies that we're on a never-ending course of a inflating dollar, permanent open market aberrations. For as long as they continue, the dollar index will continue going lower. And because of that, once permanent open market operations comes to an end, we should be able to find support and go into the opposite direction as markets trade on future anticipation or expectation. All right. Now, if we break below the 76 level, we should be able to trade down to the $72 level. All right. Next chart, we're going to go ahead and review the Euro US dollar. I was actually looking over the Euro US dollar. And basically, I felt that there was a great short opportunity right around the $1.40 area, $1.404. And basically, we went down to around $1.40, which basically equates into around 40 pips. And we even went down to the 1.398, which would be 60 pips. Realistically trading, though, I was anticipating a short scalp. Turned out to be great. This is a call I made last night on Facebook and Twitter, I believe. And that turned out to be very well done. Another thing that I do want to point out is that the Euro US dollar should be able to continue higher, because we do have a really strong uptrend in the Euro US dollar. I don't see it abating anytime soon. But judging by this chart pattern right here, if it holds out like that for at least for a whole day, you see like this whole entire flat movement, sideways consolidating period, you're basically going to see the markets consolidate somewhat like that. They're just going to roll over in something like that in a sideways pattern until we can figure out something and break below the support level or break above the resistance. So that's what you can anticipate. Alright, next chart, we got the US dollar Japanese yen. This was a currency pair that I was really positive in. I was anticipating the US dollar to go up significantly. At around 79 was when I was really bullish on it. Now, of course, we had a minor pullback here and there, but basically what the G7 decided was that the Japanese currency was a little too volatile. It has gone down a bit too much. It doesn't meet. It's just too destructive for the Japanese economy. It's basically a way to stimulate the Japanese economy after this recent crisis, nuclear issues. You have issues with a tsunami, electrical issues, earthquake issues, all at once. The economy really needs it in Japan right now. This is a country that relies on exports like no other. And because of that, it's very important that this currency goes back up, the US dollar goes back up into the proportion of the Japanese yen, because the stronger the US dollar gets, the more we can purchase from Japan at a cheaper price. As you guys noticed, if you guys notice, the Korean won, which is basically corresponding to Samsung and LG, why are their products generally cheaper than Japanese products? Why is it that you see Samsung's and LG's cheaper than Sony's? And the main reason being, or one of the main reasons, is that Japanese engineers and people who work in those type of fields are paid a lot of money, and you also have an issue with the whole entire currency thing because of the US dollar being relatively weak to the Japanese yen. We end up spending more to get the same exact product. So what basically happens with us personally is that it's much cheaper to buy from a weaker currency like the Korean won, which is from companies like Samsung and LG, than it is to buy from companies like Sony that come from Japan. So that's just a quick brief on why you can see TVs coming out of Sony a little bit more expensive than TVs coming out of Samsung. There's a reason for it. Alright, now let's go ahead and look at the next chart. Let's go ahead and review the XAG USDO. Now this is the thing, this is a silver market, which is the silver forex, and basically my theory goes like this. I saw the area at $34 last night. I anticipated to move to the upside. We got it. We're basically touching the 20-day moving average. We haven't broken it yet. Honestly, if you guys bought into that recommendation, I would get out right now. Main reason being is that the silver market is a bit overbought, and if it can't really break above this 20-day moving average, it could only go lower, and this would just be a continuation of the downtrend. Now, if it were to break it, you could easily go back into it and anticipate a trade back into the $36 level. So what you're basically playing is cat and mouse right now, but a very smart game of cat and mouse. I wouldn't risk it at the 20-day moving average. I would just wait for it to break and confirm above it. Alright, now let's go ahead and look at the next chart, which is going to be Apple. I am a bit skeptical on Apple, and the main reason why I'm skeptical of Apple is because of the fact that we have some very, very big issues coming out of them. One thing I really don't like is that one of their main manufacturing partners has, they haven't been showing much of a growth in earnings, and that growth in earnings is not going to meet the expectations analysts have. Hanhai, which Hanhai Manufacturing, Apple's largest manufacturing partner in China, hasn't seen much growth. Apple needs a lot of growth to sustain these earnings. So if a manufacturing partner isn't manufacturing as much, and Apple is in need of humongous earnings, on top of issues coming from chip manufacturers from Toshiba, they can't produce enough chips to meet demand maybe, who knows what. The bottom line is that there's some issues coming out of Apple. They need to improve their earnings by around 56% from the previous year. You know, they released phones for the Verizon network and all. That's all great or whatever, but there might have been a drop in demand, and a drop in the demand basically shows a lack of manufacturing as well. Their main manufacturing partner has seen a decrease in growth. So that being said, can Apple meet those expectations of growth? Probably not. If those earnings miss, guess what, guys? This stock will most likely go back down to the 200-day moving average at $300 and could break below, because everybody trades on future anticipation. And the only reason why these prices are so high is because of the fact that people anticipate a lot of growth, accelerated growth, accelerated growth. If you don't get that accelerated growth, the future anticipation of even higher prices goes away, and eventually people are left holding the bag and they start selling the stock because their expectations have changed. So that being said, you're going to see a lower PE ratio similar to what Microsoft has at maybe around 20 PE ratio. Apple trades at around 35 PE ratio. That would make the stock turn into a $360 stock into a $225 to $250 stock. That being said, you got to keep those things in mind and just be well alert. Alright, let's go on to the next chart, which is China's Shenzhou Mining. I anticipate this stock will go lower. Shenzhou Mining is basically a small cap play that has been hyped up just recently. I anticipate it will be breaking the support line right here and the support area is basically at around $3, and I'll just zoom in a bit for you, but basically around $3.40. You know, just in this general area, if it's broken, anticipate a trade down into around the $2.50 area, and there might be some support at the 200-day moving average. If it breaks below the 200-day, you can anticipate a trade down into around $2 and give or take $2.57, $2.50, $2.46, somewhere in that area. That's where I take my profits for around a 20 to 30% profit at these levels. All right, and do note this is a short. Ford, I think Ford has some great opportunities at around this level, which is around $13.75. Right now, this is great support. I do think that over the longer term, Ford will perform very well, and I do think this price is reasonable at around $14.26. Buy into this longer term trade, because this is going to be, you know, maybe a 3 to 6 month trade that you'll probably have to hold on to for it to be very profitable, because it could be, you know, it very well could be. It could, you know, basically result into around a 30% gain, and a 30% gain is enough for any portfolio manager to outperform the S&P 500. So keep in mind that this is going to be a great play for if you want to play the multi-month target. All right, moving on. Let's look at the next chart, which is Honda Motor Company. Honda Motor Company has seen a huge breakdown in a flag pattern. And you know, a lot of that is basically nuclear issues, tsunami, and earthquake issues coming out of Japan, but that doesn't directly affect the stock by much, except for hampering manufacturing over the short term. There's nothing really major that's going to really impact the stock. So over the long term, these valuations are very attractive. You're getting valuations that you saw back in 2010 flash crash scenario. So the stock price is pretty good, and if you're a longer term investor and believe in the Honda story, I would consider buying into this just for a longer term investment. The same thing, the same logic goes for Sony. Although I really can't pull up the Sony chart right now, you know, but basically I think Sony has the same exact story there, and the same thing with Toyota Motor Company. Well, that does it for me for today. Long-term investments in Japanese stocks are available, and that goes with Ford as well. Take care, folks, and I will see you guys next time.